Welcome to the Financial Math lecture on stocks. As we've seen in the previous lectures, most of, or just about everything involved a contract, and we had a lot of certainty. So you have a mortgage and you know what the rate is, you know how much you have to pay every month, and you know how long it's going to last. Similar things when you buy bonds, they have a rate and a term. With stocks, things are much less certain, and that makes the mathematics more difficult. There's a lot of models that'll involve probabilities. However, in this lecture, I'm going to just focus on some of the less uncertain aspects of stocks, basically dividends. And we'll go through a few different models of dividends and do a few examples. On this slide, I have a comparison between bonds and stocks, just to emphasize that the stocks are much less certain. So we have per feature here on the left. If we look at cash flows, we know bonds have these fixed coupons every month or every quarter, every year, or whatever. And then some stocks have dividends, but they can change and they're discretionary. So you may have us purchase the stock with dividends, and then the board of directors and the company decide to discontinue, for example. Bonds have a fixed maturity date, and stocks are basically whenever you decide to sell them, unless the company goes out of business, and then, of course, you don't have a choice there. Redemption value would be the face value at maturity. There's no guarantee on stocks as to, depends on when you sell them and the market conditions then. Priority of assets. So if a company goes under, goes bankrupt and closes, the bonds have first priority. So the bondholders have to get paid first from whatever assets are left. And then if there's any money after that, the stockholders might get something. Then the big difference here in terms of being more positive for stocks is bonds have a fixed upside, but stocks over the long term typically outperform bonds. So that's the advantage that outweighs some of the uncertainty. Then on the bottom of the slide, I just have some attributes that we use in the following slides. Some of these you've seen before, some of them are new. P is the current price of one share, so think of P as price. I know before we were using this as principal. D is for dividend, so a dividend payment per share. Then D sub 0, the most recently paid dividend. Then D sub 1, the dividend expected one period from now. Then G, the expected constant growth rate of dividends per period. So that's a new one. We didn't have that before. And then R, the required rate of return per period, also called the discount rate or cost of equity. So this is kind of what you would expect to make in order to invest in a stock based on the dividend or expected dividend. And then N is the number of periods. So these could be days, months, quarters, semi-annual, or years, typically. Okay, so what we're going to do following this slide is I'm going to look at different models for dividends, and we'll see the models get a little bit more complicated as we move along, but still we're not modeling the full complexity of stocks here. We're just kind of taking a sliver of a very complicated subject just as an introduction. We're going to look at a few different models for dividends, and as I stated before, these are not expected. It's not required, I should say, for every stock. Some have dividends, some don't. And even when they have them, they can change. But we're taking the simplest model here where the constant dividend is expected every period forever. We'll call that D. And then R is the required rate of return for someone in order to investor money in the stock. So this is more subjective here, this rate R. And what we have here is the present value given this dividend. So you notice that this is the present value 1 period out, then 2 periods out, 3 periods out. So it keeps getting less and less because time is transpiring and you need to buy the stock now or not buy the stock now. So that's the computation for the present value. Maybe I should have called this PV instead of P, because it's not the actual value of the stock. So if you do this computation and the present value given your computation is 100 and the stock is selling for $150, then it doesn't make sense given your expectations here to go ahead and buy it. On the other hand, if the present uh, if the present price of the stock was say $75 and this computation came to 100 again, then you would say, well, the present value is worth more than what the stock is selling for, so I'll go ahead and make the purchase. Now, there's a whole lot of uncertainty here. One is in particular, is the dividend, because this doesn't typically happen where you can expect a constant dividend forever. So again, this is a simplification. So let's take this and sum it up. We know this is a geometric series. The first term is d divided by 1 plus r. We can factor that out. And then when you get is the geometric series, first term is 1, the second term is 1 over 1 plus r, then plus 1 over 1 plus r squared. And since r is greater than 0, we have this x is less than 1, and the series converges. We can use the formula for the sum of an infinite geometric series, which I've done here. You put the first term on top, 1 minus the ratio, and you just do a little bit of math, and you get d over r is the sum. So a stock paying a constant dividend forever is mathematically equivalent to a perpetuity. That's something we talked about in the previous lecture. So I have a little bit here in terms of intuitive interpretation. From an intuitive standpoint, the convergence of the infinite series reflects the time value of money. The dividend received years from now is worth less than the same amount received today, because money available today can be invested elsewhere to earn a continuous return. So as I mentioned, these numbers in the summation keep getting less and less because you're dividing by a bigger number here in the denominator. As the number of periods increases, the discount factor grows exponentially, causing the present value of dividends received in the distant future to shrink rapidly to 0. So these terms go to 0, but they sum to a specific value, which we just derived. The exponential decay explains why an infinite number of future payments yields a strictly finite present value, d over r, as dividends expected decades or centuries from now contribute almost nothing to the current price of the stock. Okay, so let's look at an example of this on the next slide. Let's look at an example. A company is expected to pay a dividend of $2.40 per share at the end of each year, indefinitely, or at least in terms of the investors' horizon for their investment. An investor requires a return of 8% per year. What is the theoretical price of the stock? So we can use our formula, equation 1 from the previous slide, and we just plug in the required rate here, R, and then the dividend amount. And we see that the stock price of $30 is sort of the break-even point. So for the investor, the idea is that they can make 8% with some other investment of similar risk. But if the stock looks better, then they might buy the stock. So if this, let's say the stock was $25, then that would look good to them because they would be getting it at a lower price than the present value of $30. Now, if the stock was say $35 or $40, then they'd be better off going elsewhere where they presumably they can get this 8%. Maybe it's a bond or something. So that's the idea here. And it's kind of simplistic, but again, if there's a stock that's been fairly steady with their dividends, maybe a large company that's been around a while and the market is fairly steady and the investment horizon is maybe only a year or two, maybe the investor feels confident in using this calculation to see whether to buy the stock or to go with this other investment that they might have available to them. We have a variation of our simple model here. It's called the Gordon growth model. We assume that the dividends grow at a constant rate G per period. So the first dividend is D sub 0. Then the second dividend, D sub 1, is just 1 plus G times D sub 0. Then D sub 2, you just take 1 plus G times D sub 1. You get this here and so on. And we can write all these in terms of D sub 1, which is what I've done here in this formula. So this is the present value. So we have the first one is just D1 times 1 plus R to the minus 1 power, or we can write it this way here. And then these are just the expressions for D sub 2, D sub 3, and then we're one further period out each time, so the present value becomes less and less as you go further out. So very similar to what we did before, except now we have this new variable in here, G. We can factor out a D sub 1 divided by 1 plus R. We get this here. And then we use our formula for the sum of an infinite geometric series, where x is the common term. So we have 1 over 1 minus x, and you do a little bit of algebra and you get this here. And then you can just plug that back in to the formula here. So in other words, this thing in the brackets now is this. And you got to multiply by D sub 1 divided by 1 plus R. And the 1 plus R's cancel out and you get this formula. So very similar to the formula before, except now you're subtracting this growth rate. And the assumption is that R is greater than G, and G can be negative. It'll work if, for example, if instead of the dividends growing, maybe you have a stock where you've projected that there would be a decline in the stock. So you could actually, or a decline in the dividends, I should say. So there you might have a negative G, and this formula will work in that case also. On this slide, I have a few comments related to the Gordon growth model. I copied the equations down here at the top just so we can refer to them. And I may have mentioned some of these already, but it doesn't hurt to emphasize the point. So the summation begins with D1 rather than D0. So in financial models, D sub 0, that's the initial dividend, that was paid at present. And the investor purchasing the stock today is buying the rights to all future cash flows, which commence at the end of the first period with dividend D sub 1. The previous owner retains D sub 0, therefore D sub 0 is excluded from the present value calculation. So you can see here we started with D sub 1 in our calculation here. Okay, so that's just a convention. I mean, we could have numbered things differently, but this is how it's typically done from what I understand. Um, then equation 2, this equation down here, requires R being greater than G. Remember, G is the growth factor. So if G is greater than or equal to R, the denominator is 0, which of course we don't want that, or negative, which signals that the model breaks down, right? We don't have the stocks selling at a negative price, so R needs to be bigger than G. And as I mentioned on the previous slide, I'll just to emphasize the point, G could be negative, so that's also a possibility. We have a couple of examples related to the Gordon growth model. The first one makes use of our formula equation number 2. A company paid a dividend of $3 per share this year. Dividends are expected to grow at 4% per year indefinitely. An investor requires a return of 10% per year. What is the theoretical price of the stock? So we're giving D sub 0, and we know how to compute D sub 1. It's just $3 times 1.04. So the next dividend would be $3.12, assuming this growth is correct. And then we use our formula number 2. So we plug in D1 here, and then R minus G, and we get $52. So if the stock was less than $52, the actual price, then it would make sense to buy it. If it was more, it would make more sense to go with this required rate of return of 10%. Then we have a second example. Suppose the stock in example 2 is currently trading at $65. What is the required rate of return does this imply? Okay, so we already know this is not a good buy based on this analysis here, but we're being asked, well, what rate of return would kind of make this the break-even point? So we can do that by solving equation 2 for R, which I've done here. Then we just plug in the numbers we have. We already computed D1 up here. So that's 3.12 divided by P, which we're given, the current price. And then we add in G, which is 0.04. So we get 8.8%. So a buyer willing to pay $65 is implicitly accepting a required rate of return of approximately 8.8% per year rather than 10%, which was the initial assumption. This may reflect greater confidence in the company's prospects, in other words, the stock itself, not the dividends, or a lower tolerance for risk compared with the investor in example 2, or maybe the calculation here was just wrong, and based on more input and information, the investor decided the required rate of return was more like 8.8%, in which case this would be the break-even point. Okay, let's continue. We have some more models to look at. We have some derivations on this slide. In fact, we already used the first one, but I'll state it here more formally. So rearranging equation 2 from our Gordon growth model, we can solve for R, which we did in the previous problem. The two terms on the right, so in other words, this term here and the G, they have natural interpretations. The ratio D1 to P is the dividend expected in the next period, the D1, divided by the current price. It represents the income return, the return from cash dividends alone, analogous to the coupon yield on a bond. So this is sort of your return. Then the capital gains yield under the Gordon growth model, the stock price itself grows at a rate G each period. This can be verified applying equation 2. One period later, we get P1. So in other words, the price one period out is equal to D2 R1 R minus G. Then we plug in the expression for D2 in terms of D1. We get this here. And then this part here, the D1 over the R minus G is basically P. And so the P1 is actually the price from the current period times 1 plus G. So in other words, the rate of price appreciation equals G under this Gordon growth model. We were able to prove that here. Hence, equation 3 states the total return on a stock equals its dividend yield plus its capital gains. That's this equation here. Let's look at an example that uses the formulas from the previous slide. So a stock trades at $40. It's the current price. The most recent dividend was $1.60, and dividends are expected to grow at 5% per year. Compute the dividend yield, the capital gains yield, and the total return. So first we'll compute the dividend, D1, the first dividend. That's $1.60 times 1.05. This takes into account the 5% growth, so $1.68. Then from the previous slide, we computed, or we identified, I guess you would say, the dividend yield. That's D1 divided by P. That's 1.68, which we just computed, divided by 40, and that gives us 4.2%. Then the capital gains yield equals G. It's the same as the expected growth in dividends. We proved that on the previous slide, and that's 5%. And then to get total return, we just add these two together, and we get 9.2%. On this slide, I want to talk about the price to earning ratio and relate it to the Gordon growth model. You've probably seen PE ratio talked about a lot if you follow stocks at all. And we define it here in equation 4. It's the price per share divided by the earnings. The Gordon growth model sheds light on what the PE ratio represents. If we assume that a company pays out all of its earnings as dividends, in other words, the payout is 100%, which I know isn't typical. The companies normally would reserve some money for investment or reinvestment. But under this assumption, the dividends grow at rate G, and then the dividend 1 would equal the earnings at the end of the first period, assuming again that there's 100% payout. And then you can just plug that into the Gordon growth model formula. So we're putting in E sub 1 for D sub 1. We get this here, and then we can just divide both sides by E sub 1, and we get the PE ratio at the end of the first period. It's 1 over R minus G. We'll call that equation 5. And so the PE ratio is just a reciprocal of R minus G. And then the high PE ratio can reflect either a low rate of return R or a high expected growth rate. So basically when these two numbers get close together, then when you divide that into 1, you get a larger and larger number. So if the growth rate and the required rate of return are almost the same, you're going to get a large number here. Now, we assume that G is not greater than R, so that's, you're not going to get a 0 or a negative here. Then there's something called the EP ratio. It's just the inverse, or the reciprocal, I should say, of the PE ratio. And that's called the earnings yield, and it equals R minus G, obviously, right? It's just the reciprocal of this under these assumptions here. Okay, and this was just the caution. I already mentioned this. I have an example here using some of the ideas from the previous slide. Given the following, assume 100% payout of dividend, E sub 0, the most recent EPS equals $1.60. So this is the earnings per share. Then the growth rate is 0.05. the required rate of return is 0.092, in other words, 9.2%, and the stock price is $40. So we're asked to compute E1, P, the PE ratio, and then the EP ratio. So E1 is just taking E0 and then applying the growth over one period. So it's $1.60 times 1.05, get $1.68. Then the PE ratio is the price, 40, divided by E1, which we just computed. So we get 23.81. And we can also compute that using our formula, 1 over R minus G. Then we take R minus G, we get 0.042, and we also get 23.81, which is what we would expect. And then the earnings yield is just the reciprocal here. So it's 1 divided by 23.81, and we get 4.2%. Then as a check, we know that the price should be the earnings, again, under this 100% assumption here. This is essentially D1 divided by R minus G. So we take our $1.68 and divide that by R minus G, 0.042, and we do get $40. To accommodate situations where a company retains a portion of their earnings for reinvestment, which, as I mentioned, is typical, we introduce a variable for the payout ratio. We'll call that X. It's the fraction of earnings distributed as dividends. So we have our dividend is just this fraction, X, times the earnings. And this is a more practical model. It's pretty easy to fix. So to get the Gordon growth model, we just plug in D1 here, and we have this equation now. So this version of the Gordon growth model based on a percentage of earnings. And we can also compute the first PE ratio at the end of the first period. And that would be just working from here, we're just dividing E sub 1 into P, and we get X divided by R minus G. And we'll call that equation number 6. Okay, so this is probably more practical because the companies typically do reinvest some of their earnings. And so we can just put in a percentage here, and that gives us probably a more useful formula than the one we had just before. On this slide, I have some of the limitations of the dividend-based models that we've been talking about. Some I've mentioned before and some I haven't yet. So dividend discount models are elegant and mathematically clean. As we've seen, they're pretty simple formulas, but they rest on several strong assumptions. Understanding these limitations is important as knowing the formulas. So let's look at these. So first one, many companies, particularly young, high-growth technology firms, don't pay any dividends at all. They reinvest all earnings. For such companies, dividend-based models cannot be applied directly. So you need to have different approaches, which we're not going to be covering here, but I'll just mention that, such as discounting free cash flows or using relative valuation metrics. Then the constant growth rate, that again may not be the case. And so we may need a multi-stage model. So you might predict one growth rate for a few years, and then maybe the expectation is the company will do better in terms of dividends or less. So if you want to predict further out, you may need to have a multi-stage model. Again, this is something we're not covering here, but I just want to mention the limitations and what we've done so far. Then there's sensitivity to inputs. Equation 2, and actually all the other equations that had R minus G in the denominator are very sensitive to small changes. So I have an example here. If we have R 10 and G equals 8, We take the difference, 2% or 0.02, and you divide that into 1, so you basically get 50 times D1. However, if you just raising G by just 1 percentage point to 9% or 0.09, now you're dividing by the difference of 0.09 and 0.08, and that's 0.01, and so now you're going to get 100 times D1 for the theoretical price. So you see, just by a slight change in the interest rate for G, you're getting double the price. So small changes can make big changes in your calculation here. Market prices reflect more than dividends. So this has been very much focused on this lecture on whether to buy a stock based on the analysis of dividends. But as we said, some companies don't even have dividends. Other companies are, do have dividends, but maybe they're in trouble. So you want to be concerned about buying the stock, even though it's giving you a dividend now. They may not have a good outlook for the future. So actual stock prices incorporate investor expectations about future earnings, as I just mentioned, macroeconomic conditions, interest rates, sentiment, and many other factors not captured by a simple dividend model. So market prices frequently diverge substantially from model values. Again, models relating to the dividend models, sometimes for extended periods. And then, as we mentioned, dividends can be cut, and of course they can go in the other direction too. Okay, so these are the limitations. And on the next slide, I just have a summary of some of the formulas that we've been talking about. You may want to do a screen capture on this. These are the 5 equations we developed. We started with the simple model and then the Gordon growth, where we assumed growth in the dividend amount, right? And then we solved for R in this equation, and we got this one here. Then we talked about PE ratio under the assumption of a full payout. All the earnings were paid out in terms of dividends. And then we modified the formula for the case where the only a portion, a fraction of the earnings were paid out. That fraction was called X, and we got this formula here. Okay, so if you want to do a screen map, go ahead and do that. I also have published a book now related to this set of presentations, the whole set of presentations actually, and the information on that I'll put in the description of this video. I'll point you to the if you're interested in the paperback, I'll point you to the Amazon link for that, and the electronic version I'm making available free, and I'll give you a link to that also. I have a little bit more I want to show you because I have a program, a Python program that does some of these formulas. I mean, they're pretty simple. You can do them by hand, but I did develop a program that I'll make available also, and I just want to demonstrate that to you in the following slide. This is the program I said I would mention. I also make the code available. It's written in Python. It's pretty basic. I have 4 different windows here. Let's look at each one. So the first one is the basic model where there's not even a growth rate. And you give it 2 of the 3 variables and it'll compute the other one. So let's do the price first. So you give it the dividends, the required return, and then it'll compute the price. You can see that. Just to show you something different. Let's say that we could do that, and we'll leave R blank. And you need to come up here and just say that you want to find R, and then you hit the compute button. So it computed R. It just rearranged the formula. Then we have the Gordon growth model, and that allows you to put a G in, a growth rate, and it can be negative. In fact, let's do that. So let's say the dividend is $4 and we think it's going to decrease. So we'll just put a minus. Then we want a growth rate here and it'll compute the price. So 56.57. You notice it first computed D1 and it used that in the formula to get the price using R and G. Okay, and you can play around with this. You can give it any 3 of the 4 and it'll compute the other one. Then you can clear it if you want to do a second example. Then this one computes the return. Let's give that here the dividend. Let's say that's $8 and it's growing. Let's say it's growing pretty fast. And we have a stock price, I don't know, $89. And that'll compute the R, this number here. It'll also compute the dividend yield, which is D1 divided by P, and the capital gains, which is G. Remember, we broke this formula up, and then I went through what each one of these mean. And so it'll compute each one of these separately, and then also R. And there you go. So you have the dividend yield, the capital gains yield, the total required return, which you have here, and then it's just using the formula directly. You notice this is written in decimal format, but it's, if you round this off, it's basically 12.26%. Let me clear this and go to the next one. This computes the PE ratio. So we can do select price, and we'll give it the earnings, and this is assuming that 100% of the earnings are distributed as dividends. So let's say we have 9. Let's do a negative. Yeah, let's do a negative again. Negative growth rate. So this is getting smaller each time. And let's say that we want to make 10%. And it'll compute the price, and then it'll compute the PE ratio. Yeah, so it's just telling you here that it's assuming 100% payout, so D1 equals E1. It computes E1, then it computes the price, which is 73.50, and then it computes the PE ratio. It just takes the earnings and divides that into the price, and it gets this number here. So it divided $88.82 into $73.50 to get this number here. Okay, and you can do different combinations. What I didn't do on this one was the fraction x. Remember, I showed you where you could take a fraction of the earnings and just distribute that fraction. So if you wanted to play around with the code, you might want to enhance it to have an additional parameter. Okay, so I'll tell you where this is on my GitHub, and you're free to download it and use it or enhance it. You can do whatever you like with it.